Bevan Jones. He's the Chief Executive at Thebe Resources Incubator. He now joins us for more on that. So I almost gave you a promotion there earlier on. Bevan, thanks so much. You've heard what Sven had to say. A couple of things there. He said cost-cutting measures. They may have to merge with other operators. He says he believes this gold price could recover. Do you agree?
I think so. I think, look, gold is typically traded as an interest rate play. It's effectively a currency play as well. So, for instance, you could buy the new gold ETF and you could sell gold futures, and you would effectively be short the rand, because as you know, new gold made money, you would make money on your position. So it's very much a currency play, and as Sven pointed out, very much related to the US dollar, and they've seen a currency impact on the cost side. On the demand side, I think certainly we'll see more demand from China. Every man and his dog in China has rushed into equities, and they've now got the fright of their life. And I think they'll go back to being gold bugs. And you know, we've also heard talk of the new BRICS bank looking to hold significant gold reserves. So whilst other central banks have reduced their gold reserves, you know, the BRICS bank might actually be quite a significant holder of gold. So I think long term the demand is there. You know, gold, I just looked last night, gold has only dropped about 17% over the last year, whereas something like iron ore has dropped 150%. Bitcoin, all these people talk about as the next currency, that's dropped 100% in a year. So gold actually hasn't performed too bad in that regard, yeah.
Okay, so yeah, gold hasn't performed too bad. I still remember the sort of highs of what, $1,700 now. Yeah, and I look at it now, and I think it's pretty much dropped quite badly. Yeah. But what about other commodities? I mean, you mentioned iron ore. I mean, you know, my view is also, you know, massive supply glut, China not growing as fast. I mean, this is here to stay. Would you agree?
Absolutely. I think iron ore has had a triple whammy where steel plants have been closing down in China because of pollution concerns, because of growth concerns, etc. Massive oversupply on the production side. And iron ore is one of those industrial commodities that I call the sort of more intelligent commodities that actually tell you what's going on with the state of the world. The others are coal and copper, and probably the most intelligent commodity of all is the dry freight market. And that's never recovered from its 2008 low. It's simply been bouncing along the bottom, indicating that the state of the economy is actually pretty poor. And you've seen all this false money sloshing into equities over the last few years. But commodity prices, those bulk commodity prices, have been telling you that actually things are not that great. Coal has, coal has fallen 26%, copper about 30% in the last year. Crude oil prices have fallen about 90% in a year. And iron ore has fallen, about 150%. So it's been pretty bad all round.
You say that, I mean, a lot of obviously loose, you know, monetary policy forcing cash into equities, but the underlying state of the economy is not as great, you know, based on resource demand. But surely falling resource prices actually means that almost as a globe we're getting richer, because you know everyone has, you know, more access to resources at lower prices.
Yeah.
I mean, we understand that oil, obviously, it's the you know, the almost the breakdown in OPEC is, you know, bringing more supply onto the market. Surely this is
shale,
and shale and technological revolution. Surely this is fantastic for you know, the man on the street, for consumers.
It is fantastic, and I think what we're also seeing is we're seeing a whole new bunch of commodities, this whole new energy wave in renewables, and solar power prices have been coming down significantly, and that's competing with coal as well as gas, and we're seeing a complete new industrialization emerging, which is fantastic for the economy. But I do think a lot of old economy stocks are probably maybe slightly overvalued if you consider where we're actually at in the price of real commodities. But you know, commodities, there's always going to be a cycle. So as we've seen prices drop, we're seeing supply being pulled from the market. People like Glencore and Irving Glasenberg very vociferous in saying we have to pull back supply, and that's slowly happening. And in something like iron ore, I'm not too sure that's that's the case, because they're pumping out more iron ore than ever before. But that's a bulk game, and it's only the brave who win in that game.
We're going to pause this conversation. We're going to a quick break. When we come back, we'll be picking up this discussion with Gary and Bev, talking all things resources. Still with me, I've got Gary Boyson, and I'm still joined by Bevan Jones. Of course, he's the Chief Executive of Thebe Resource Incubator. Now, earlier on, we heard from Sven with regards to gold fields about what it would mean if we saw the gold price dip below that 1,000 mark. We did ask Anglo Gold Ashanti to respond on what it would mean for them. And there's quite a lot that's been said there, and that is an official statement from them. They talk about the recent gold price and its volatility and the pressure that it's put on the gold industry. And they said there are price takers. And if we move on to the next board, where they do talk about some of the measures that they've put in place, so they said they continue to actively control costs. So again, we are still seeing that come through in terms of cost containment, and they also want to ensure that each of their mines will, in order for them to ensure that there are ongoing capital expenditure remains viable. There's a final board in terms of their response there, and then they're saying that, you know, that they certainly require cooperation from all stakeholders, including government and labour. Right, so that's what AngloGold Ashanti has had to say. Bevan, would you say that gold producers are in a worse off position than platinum? Because we've seen platinum last week dip below the 1,000 mark.
I think South African gold producers are obviously playing in a global game where there's other nations. I mean, we've slipped in the gold production status in South Africa as a country, and obviously our producers have obviously gone global as well. I think South Africa is a tough environment. There's no doubt about it. We've, you know, our labour disputes, etc., our costs of mining, our deep level mining. I think, you know, we some of the deepest mines in the world, and there's this whole debate about mechanisation, but that entails potential job losses. So it's a very difficult situation to operate in. Platinum, perhaps slightly shallower, but also has some of the same issues. Platinum, obviously, it's mainly South Africa and Russia, though, and you know, there's that argument that says, well, maybe we should try and determine our own destiny in terms of the platinum price, because globally, gold and platinum are set by the London Bullion Market Association banks. They used to have the little flags that they had up and down, but now it's much more electronic. But again, the price is determined in London based on what people think is happening in a supply and demand. But potentially, in terms of platinum, we could create a platinum market, a South African platinum market, perhaps in conjunction with a big producer like Russia, and perhaps take some of that power ourselves. But then again, you know, people would look at, there's alternatives, there's synthetic alternatives like mullite and other, you know, and if platinum became too expensive, people would find other uses and they would bring in alternatives. So it's a difficult one. The jewelry demand is there, and India is a great market for gold jewelry and platinum jewelry to some extent. But those are seasonal factors as well. You can't really rely on those.
Perhaps if we saw a little bit of a run up in the price, we'd see more money flowing into the ETFs, because I think it's an investment vehicle at the moment. It's not there. I mean, as an investment vehicle, if we had to look across, I mean, the whole commodity basket has been hit. Where are you guys finding, which commodity is the most exciting for you at the moment that you think still has a great future and that we're going to see a recovery in?
Yeah, so Thebe, at the Incubator, we really try and develop emerging entrepreneurs in the mining space, and we use enterprise development funding, etc., for that. So we're really trying to grow from grassroots level. Personally, myself, you've obviously got shares in platinum and gold shares, and that exposes you to specific risk in those companies. As an ETF, you're exposed to the physical metal, which reacts much more to supply and demand fundamentals. If you trade in something like an ETN or the note, then you're exposed to futures, and futures have this interesting concept of this forward curve, where from month to month you sell your position and you buy the next month's position. And if the forward curve is in contango, which means that forward prices are higher, you would be buying the next month at a slightly higher point. So you potentially be losing money on that roll. But as most commodities at the moment are actually in backwardation, where forward prices are slightly lower, you actually make money. So it's almost a bit of a dividend that you get on these ETNs. So you're buying the next month at a slightly lower price, and you're pocketing that difference. So ETNs can be very effective, but you need to understand the fundamentals of the supply and demand in the market. And of course, the big funds that are, you know, stashing these things in physical vaults in Switzerland, etc., they are having quite an impact now, because central banks, as I said earlier, are holding a lot less gold and platinum reserves.
I just want to understand the rationale. You mentioned the BRICS Bank wanting to use more gold, while that's not necessarily what we've been seeing in other central banks.
Yeah, so I think central banks have typically used gold reserves as an interest rate hedge, and you'll find, you know, gold has always had this strong negative correlation to interest rates. As interest rate goes up, gold prices effectively come down, because what central banks have been doing is they loan out their gold reserves and then they buy them back, because that's a reverse interest rate sort of trade. But I think, you know, there's probably been a lot of calls on central banks to fund and that money's found its way into equities and bonds, etc. And you've seen gold reserves having been sold down, probably through those calls. Same with a lot of calls in the Chinese market, margin calls. You've probably seen a lot of gold, physical gold holdings that have been sold down. People have lost faith a little bit in gold, but I think that'll start to come back. I think people are starting to see that gold has been here for forever, and it will be with us for a long time still. And it is something that can give you an underlying sort of protection of value. I mean, 17% is not too bad when you compare it to the gyrations of the iron ore market.
Well, thanks for putting that into perspective for us, Bevan. And when it comes to gold, I saw a note out of Macquarie on Friday saying gold really has lost all its appeal. But we'll see. We'll be watching this space, and
when everyone's saying one thing, maybe it's time to do the other.
Well, we'll get you back and find out how things went there. Thanks so much to Bevan Jones. He's the Chief Executive of Thebe Resource Incubator.